Wednesday, March 20th, 2019, Maneco 64, home of alternative economics and contrarian views. So Billy is back this morning. I'm drinking my coffee with an old Billy mug that I have here. You can see here Billy and Maneco 64. I will be relisting this mug. So if any of you are interested in a Billy mug, there are links in the description below to the maneco 64 Teespring store. This morning, I want to talk about a couple of things. One interesting article I saw on Zero Hedge. It's entitled, "Is the Bull Market Too Big to Fail?" By Joseph Carson. And I also like to look at the globalist magazine, The Economist, which some of you might know I started subscribing about 6 months ago. Will I renew my subscription after a year? Maybe, maybe not. I'm not sure if it's worth it. There are some interesting articles in there. That's what I want to talk about today for this week's edition. It's the article is called "Carry That Weight." So it's here. And The Economist has talked about this before. It's about corporate debt and how corporate debt has actually been rising quite relatively sharply compared to household debt, and how it could trigger the next crisis. So I'll look at that in a minute after I've looked at where the markets are this morning. So it's 7:40 a.m. London time. So today is Fed decision day. I don't think, as I've said earlier this week, they're going to do anything, but it will probably most definitely move the markets. It's going to be at 6 p.m. London instead of the usual 7 p.m. So right now, spot gold is down about 1303. So I saw yesterday, same pattern as the day before. Gold did well early on in the day. We even almost made a new high from the previous day. We got up to around 1311. And as usual, as the US day progresses, gold drifts lower. And overnight, it's drifted a little lower as well. So yeah, disappointing, but patience required, I would say. Silver, the same thing. Silver is underperforming a little bit at present. Silver is down 6 cents at 15.30. The range has been 15.28 to 15.39. The high overnight in gold has been 13.07.25. The Dow is down 26, 25,877. Yesterday, the stock market finished lower. The Dow finished down 26 points. The S&P finished down marginally. The NASDAQ composite finished up 10 points. But I noticed that the Dow Transports had a fairly bad day. It was down triple digits. Why is the Dow Transport important? Well, part of the Dow theory that you need to see the industrials and transports doing well at the same time, or making new highs at the same time, or vice versa. And the other point about the transports is, if an economy is doing well, that, transportation companies should be doing well, and that's not happening. So S&P right now is down just about 3 points at 28.31, and the NASDAQ 100 futures down about 6 at 73.45. We've got the pound down a quarter of a percent, 132.33. The euro is down 10 pips at 113.42, so marginally lower. And the dollar is 0.2 stronger against the yen at 111.60. The dollar yuan is unchanged at 671.22. Crude oil still relatively firm. I mean, it's crept up in the last few months. Prior to the last month, oil seemed to be in a range between 50 and 55. Now we're almost back up to 60. We're at 59.28 WTI. Brent is at 67.64. The Bond market. Yeah, yields went up a little bit in the last day or so. We're at 261 roughly in the 10-year. I think it's all about the FOMC decision, the press conference, and their economic projections today. So, is the bull market too big to fail? I thought that was an interesting headline because usually it's banks are banks too big to fail. So let's have a look at what Joseph Carson says. He's a chief economist, former chief economist of Alliance Bernstein, which is a Wall Street operation, I think. He says the U.S. says, and I quote, the U.S. equity market is on another streak, posting a double-digit gain since the start of the year and extending a bull run that has lasted 10 years. In terms of pure numbers, equities occupy a position far above any other asset, and in everyday life, stocks have jumped ahead of real estate as a store of wealth for Americans. And he goes on to say, from a risk management perspective, policymakers should consider broadening the definition of too big to fail to include market segments and not just financial groups, since at various times the main risks to the economy and financial system have been the high value of assets on the private sector's balance sheets. So I won't go into the whole thing, but it just goes to show you how, and the thing about this is that only the top 10% really of Americans own significant amount of stocks. So it just goes to show the inequality here. So at the end, he says policymakers have consistently argued that it is impossible to identify asset bubbles, and the best defense against them is robust supervisory and regulatory oversight. That policy does not work in practice when the risks sit on balance sheets of the private sector and easy money is part of the problem. At today's levels, the equity market is too big to fail without causing substantial damage to the economy. That would be far greater than what happened after the tech bubble burst in 2000. Since policymakers have far less capacity to reduce interest rates, and real estate is unlikely to provide the same buffer for investors or the economy. Interesting, yeah, because years ago, even before the '08 crisis, I remember people talking about it in the markets that Greenspan was able to create another bubble after the dot-com bubble burst in 2000, 2001, and that was the housing market. So now the only bubble there is really that they could go on to is the stock market bubble. But the stock market bubble, in my opinion, a big part of it is because of corporate debt. Because big corporations have been able to borrow almost for free. With that money, they've issued bonds, which is borrowing, of course. They've issued corporate bonds, and with the proceeds of issuing those bonds, the cash, they've gone on and bought their stock. They've paid high dividends for their shareholders. So the economy itself hasn't really benefited. They haven't really invested or taken care of their employees. They've taken care of shareholders, but employees, they haven't. And that's why the stock market has also appreciated all the buybacks. It takes, there's about 6 trillion in buybacks that happen, and it's the same amount of the increase in the amount of the corporate bond market. So you can see how important that is. I spoke about this a month or so, or maybe a little longer than a month ago, maybe late last year. The Economist was talking about leverage loans, which is basically kind of a junk bond, but it's not a bond. It's a loan given to corporations, to companies, and they've been also repackaging these into collateralized loan obligations, just like they did the CDOs. So this is what The Economist this week talks about. Oh, that's the cover of The Economist about the UK. Oh, you know what? So The Economist article is quite a long one, and I've read it. And it says, overloaded balance sheets will not bring America's next recession, but they may make it worse. Well, I'm not sure about that, but basically they're saying that even average investors are getting involved through ETFs, through mutual funds. There's a lot of ETFs that are invested in these leverage loans. And yeah, and the corporate, and they talk about how in December, this leveraged loan market dried up. And why did it dry up? Well, because of the stock market coming off like that. There's just no confidence in it. But by February, according to them, the market picked up and it was in great health, or rude health, if you want to call it. So this is, and corporate, debt or business debt, and they talk about, they specify it as non-financial. This is for companies that they're not like Wall Street firms, right, or other kind of financial institutions. They're like real economy corporates, and it says catching up. So right now, looking at this chart here, we're almost up to like around 75% of GDP, corporate or business debt. And household debt got up to like almost 100% just before the '08 crisis. And it's now like converging with the business debt or corporate debt. So I'll show you here the little chart you can see here, right? There you go. But yeah, it's a pretty interesting, article, quite balanced. As The Economist is, they're not like saying, oh, there's going to be a crisis or anything. They note, they even say that CLOs are probably safer than the CDOs. But one interesting point that The Economist makes about in this article is about the regulatory environment, which Mr. Carson talks about in his article. And I'll read here from The Economist. And this is to do with all these leveraged loans and corporate debt. Regulatory slippage completes the pessimistic picture. In 2013, American regulators issued guidance that banks should avoid making loans that would see companies' debt exceed 6 times EBITDA, earnings before interest, tax, depreciation, and it's an accounting term. But this was thrown into legal limbo in 2017 when a review determined that the guidance was in fact a full-blown regulation and therefore subject to congressional oversight. The guidance is now routinely ignored. The 6 times earnings limit was breached in 30% of the leverage loans issued in 2018, according to LCD. And I'll go on here for a bit further. In 2014, regulators drew up a skin in the game rule for CLOs, collateralized loan obligations, a type of regulation created by the Dodd-Frank financial reform of 2010 that requires people passing on risk to bear at least some of it themselves. But a year ago, the skin in the game rule for CLOs was struck down by the DC Circuit Court of Appeals. The court held that since CLOs raise money first and only then buy up loans on behalf of the investors, they never really take on credit risk themselves. Their skin is safe before the game begins. So you can see there, they've been able to kind of avoid regulatory oversight. So this could be something to keep an eye on. I know it feels right now that the central banks, Congress, Wall Street, they need to keep this going, this bubble going. The feeling is that it will never correct. A lot of people have been saying, oh, we've been hearing about that we're going to have a financial disaster for the last 10 years or 11 years and nothing's happened. And maybe that's what they want people to think. And then, you know, out of the blue, you know, they pull the plug. Who knows? And that's why I don't try to play around in their markets. That's why I stick to having my precious metals as insurance. Of course, I personally do have some speculative positions, but it's outside their market. It's in the cryptocurrencies. If you enjoyed this video, make sure you hit the like button. If you have been watching my videos recently but haven't subscribed yet, think about subscribing. If you're a subscriber, make sure you hit the little notification bell here to be notified of my videos. You can also follow me on Twitter, Steemit, and on DTube. I wish you all a great day. Take care. Bye.